In the first half of 2026, despite significant geopolitical developments and economic growth concerns, corporate earnings remained solid, businesses continued to invest, and market gains extended beyond a handful of large companies. This meant excellent market returns. That said, with inflation remaining structurally higher than it was over the previous decade, and likely to remain so, staying invested, particularly in assets like equities, continues to play a very important role in preserving purchasing power and building wealth. Economic growth in the US was driven largely by unprecedented private sector investment in technology, particularly artificial intelligence. The scale is remarkable. In 2026, the Magnificent Seven alone are expected to invest about $725 billion US in capital expenditures, primarily to expand their AI infrastructure. To put that in perspective, that's roughly 2.2% of the entire US economy. Just 3 years ago, it was about 0.6%. This wave of investment didn't just support economic growth, it also helped drive corporate earnings across a wide range of industries. At the same time, a meaningful slowdown in AI-related investment would represent a challenge to both economy and financial markets. During the first half of the year, the broader US equity market advanced even as the Magnificent Seven underperformed by more than 10%. For example, Tesla lost 6.5% of its value, Facebook lost 14.5% of its value, and Microsoft lost 22.5%. These results have been relatively uncommon occurrences in recent years. This year's performance reflects healthier market participation, with gains extending beyond large tech companies into sectors such as industrials, financials, and semiconductor-related businesses. For long-term investors, broader market participating is encouraging. Rather than relying on a handful of companies, market returns are being supported by a wider range of industries and businesses. Inflation has moderated significantly from the highs reached after the pandemic. However, several long-term structural factors suggest it is likely to stabilize above the low levels experienced during much of the 2010s. As a result, we don't expect interest rates to return to the exceptionally low levels that supported past booms in areas such as real estate. One important factor is persistent government fiscal deficits. Many developed economies continue to spend significantly more than they collect in taxes, supporting economic growth but also contributing to a higher inflation and interest rate environment. Although market sentiment can influence prices over the short term, long-term equity returns are ultimately driven by the ability of businesses to grow their earnings. Current consensus estimates project double-digit earnings growth for both Canadian and US companies in 2026. In Canada, resilient banks and commodity prices continue to support earnings, while innovation and productivity remain key drivers in the United States. Your portfolio maintains broad exposure to businesses in both of these markets that generate earnings and create long-term economic value, directly contributing to preserving and building purchasing power over time. We continue to complement equities with other asset classes to manage risk and provide resilience across a range of market environments. On behalf of the TWM Group, thank you for watching and see you next time.